Good morning, traders, and welcome to Bulls, Bears, and the Bell. This is your morning briefing.
Okay, let's unpack this. We are diving into a market caught between really powerful relief and this profound uncertainty following one of the biggest political events of the year, the end of that 43-day U.S. government shutdown.
Yeah, and the relief hit fast. Late last night, President Trump signed the funding bill, and boom, the market reacted. We saw the Dow Jones Industrial Average surge 327 points. That locked in a second straight record close, finishing up above 48,254.
That initial surge is a fantastic headline, isn't it? But here's where it gets really interesting, because that relief high, it's already crashing head-on into a much deeper problem created by those 6 weeks of closure. We're calling it the data fog.
That's exactly the right term. The shutdown didn't just stop paychecks. It stopped critical federal agencies from collecting and releasing the most important economic indicators we rely on. I mean, we're missing the October jobs report. We're missing the crucial CPI inflation report. This is the very information the Federal Reserve uses to set policy. They are essentially flying blind. And because of that huge information gap, the market, which usually digests 3 or 4 major data points before breakfast, is now laser focused on just one single report coming out at 8:30 a.m. Eastern, the jobless claims figures. So our mission today is to analyze how this sort of desperation for certainty is driving a powerful sector rotation and really tearing the tech market in two between what we're seeing as real AI and maybe hype AI stocks.
Exactly. The whole market narrative has pivoted. It's now entirely around which stocks can actually provide verified earnings in this fog of policy uncertainty.
Okay, let's broaden out. Starting with the global dashboard, we see this fragmented relief playing out overnight. Asia, which closed earlier, showed some cautious optimism, riding those U.S. tailwinds. The Nikkei 225 rallied 0.44% to 51,288, and the Shanghai Composite climbed 0.73%.
And the gains in Shanghai were actually supported by two things. Yes, the U.S. stability, but also a strong signal from Beijing. They plan to boost their domestic new energy battery industry. So that gives China's market a local reason to cheer too.
Right, a local factor. But if you want a perfect example of how local policy concerns can just completely override global relief, you got to look at Australia. Their ASX 200 actually fell 0.5%. Why the contradiction there?
It's fascinating, really. Australia posted genuinely strong domestic jobs. Data unemployment dropped from 4.5% down to 4.3%. Normally good news. But for traders, this was the classic good news is bad news scenario. That strength immediately just quashed hopes for near-term interest rate cuts from the Reserve Bank of Australia. Strong economy meant less stimulus likely, so the market sold off hard, completely ignoring that U.S. Dow record.
Wow. That really shows the complexity of the global picture right now. And Europe sounds similarly fragmented.
Very much so. The UK's FTSE 100 is the clear laggard today, down about 0.3%, near 9,881. It's primarily because it's completely overshadowed by their weak domestic third-quarter GDP figures. They're dealing with local economic weakness that, frankly, the end of a U.S. shutdown just can't fix.
Makes sense. What about Germany?
Well, Germany's DAX is technically flat, up just a tiny 0.1%. But that flatness masks some extreme volatility right under the surface. You've got pharma giant Merck surging over 6% on a stronger-than-expected earnings beat. And that's contrasted directly by industrial powerhouse Siemens, which is down 4.1% because its net profit missed analyst estimates.
So it's a very sharp market right now. In Europe, it really is a market of stocks, not a stock market. If you miss estimates, you get punished severely. It doesn't matter what the broader index is doing.
And that intensity carries straight over into the U.S. market, specifically into this core rotation we're seeing continue in pre-market futures. We measure this via the E-minis, the contracts representing the major indices. Dow's E-minis are holding a small gain, maybe 37 points, 0.08%. But the Nasdaq 100 E-minis are leading the way down, off about 21 points, also around 0.08%.
And the catalyst for the Dow's record close yesterday, as you said, was pure cyclical strength. We saw huge gains in healthcare, like United Health Financials too, Goldman Sachs, JP Morgan Chase. These are the defensive, traditional blue chip sectors people flock to when they want stability. Meanwhile, the tech-heavy Nasdaq slipped 0.3%.
Right. And this rotation wasn't random. It was really kicked off by a major rethinking of the whole AI trade. The news that Japan's SoftBank had sold its stake in NVIDIA. Well, that raised immediate concerns. Concerns about tech valuations that many feel had just run too hot too fast, especially for those companies where the AI promise hasn't quite translated into actual profits yet.
So this shift is kind of forcing unnecessary maturation, wouldn't you say? You have to separate the hype from the actual profit. And we saw the perfect counterexample yesterday. AMD surged 9%. That was after setting a massive $100 billion data center revenue goal. That shows the market will reward growth, but only when it has real, tangible earnings and guidance to back up the story.
Absolutely. It's separating the wheat from the chaff, or maybe the profit AI from the hype AI, as you put it. And if we connect this to the bigger picture, the cross-asset check confirms this market is essentially just waiting, holding its breath, driven by that policy uncertainty. Look at bonds. The 10-year Treasury yield is up 1 basis point that's tiny, 0.01% at 4.087%. It's entirely waiting for that 8:30 a.m. data release.
Okay, but wait. The shutdown just ended, the government stabilized. Why isn't the dollar rallying? The U.S. dollar index, the DXY, is actually under pressure, falling 0.2% to 99.29. What damage are traders focusing on?
Yeah, it seems counterintuitive, but it's actually pretty simple. The dollar was high, partly because people were scared that was the safe haven bid during the crisis during the shutdown. Now that the immediate danger of the shutdown itself is gone, the market's immediately pivoting to the economic hangover, damage caused by that 43-day closure. And that damage makes people think the Fed might have to cut rates sooner to compensate. And, potential rate cuts tend to push the dollar lower.
Got it. Okay, shifting focus away from currency, let's look at physical assets. WTI crude oil is trying to stabilize around $58.50 a barrel, but that's only after plunging over 4% yesterday. What caused that big drop?
That was down to a fundamental structural bear case from the IEA, the International Energy Agency. They're now projecting a massive 2.4 million barrel per day surplus this year. Basically, supply is projected to outstrip demand aggressively. And that puts a definite ceiling on oil prices for the near term, it seems.
Okay, so oil under pressure. But in contrast, gold is acting as the true safe haven here, isn't it? Spot gold is strong, up for a fifth straight day to $4,210 an ounce.
That's right. With the dollar weakening and all this policy uncertainty amplified by the data fog, investors are parking capital in gold. It's doing its traditional job.
Yet, despite all this rotation, the policy uncertainty, the data fog, the VIX, the fear gauge, remains pretty subdued. It's at 17.28.
Yeah.
So how is the market reading fear then? What is the VIX telling us if it isn't spiking amidst all this?
Well, it signals a lack of systemic panic. The market clearly sees specific risks like the valuation rotation, potential policy missteps because of the missing data, but it's not pricing in a complete cliff-edge collapse like we saw in, say, 2008. It suggests investors are still sort of cautiously climbing the wall of worry rather than bracing for imminent disaster.
Okay, let's talk specifics. Let's get into the stocks that really illustrate this rotation best in the pre-market moves. The gainers are practically shouting a clear message: we want real earnings now.
Absolutely. Cisco Systems, ticker CSKO, is the top large-cap story this morning, up a significant 6.5%. Why? Strong Q1 earnings beat, and they raised their full-year guidance. But the crucial detail, the thing everyone's focused on, was their new tangible $3 billion AI revenue target. They booked $1.3 billion in new AI orders just this quarter alone.
That $3 billion target is key, isn't it? While these speculative AI names are, well, some are collapsing, Cisco is rallying on confirmed, booked AI orders and profits. This is the anti-bubble narrative that institutional investors seem desperate for right now. Verifiable, monetizable AI business.
Exactly. And then you also have JD.com, ticker JD, up 5.0%. Now, this one's a bit more nuanced. It was a beat, but they actually reported a massive 55% slump in net profit blamed on a fierce food delivery price war over there. But the market seems to be ignoring that noise. Instead, they're cheering the expansion of the core JD retail operating margin, which hit 5.9%. So it's a classic, better-than-feared result, focusing on the profitable core business.
Right, focusing on the core. Now, contrast that success with the losers, where the collapse of speculative hype is just brutal. VisionSys AI, VSA, is down a shocking 75.0%.
Oof.
Yeah, this is the dark side of the AI frenzy, right? A highly dilutive stock offering designed to raise just $12 million for a company that, get this, already had negative equity. That is pure speculative cash grab behavior, destroying shareholder value.
It really is. And then you have the big one, NVIDIA, NVDA, down about 0.7% in pre-market. Look, it's not a crash, obviously, but it is symbolic. It's a continuation of that rotation we've been talking about, out of those lofty valuations and into the real earning stocks like Cisco. I mean, the massive spread between Cisco up 6.5% and NVIDIA down 0.7%, that's your clearest market tell today about this rotation.
Okay, and this brings us right back to the single biggest factor governing today's session. That data blackout. Weeks of severe information lack. Jobs report missing, CPI missing.
And this raises a really important policy question. This severe lack of data, it could genuinely contribute to a decision by the Fed to skip the December rate cut that the market had been pricing in. They simply might not feel they can justify a major policy move without those critical inputs. So the relief from the shutdown ending has immediately created profound policy uncertainty.
Which brings us back full circle to the only official release today at 8:30 a.m. Eastern. Initial and continuing jobless claims. This one single report is carrying the weight of weeks of missing data. And we know private data has been weak recently. For context, October layoffs were the highest for that month in 22 years, according to Challenger Gray and Christmas.
Right, and this creates a critical paradox for the market reaction at 8:30. Scenario 1. If claims come in HIGH, say above the 223,000 estimate, the market might actually rally. Traders will likely embrace that old bad news is good news script, betting that weak employment data forces the Fed to cut rates, even without the missing CPI data.
Okay, but the second scenario, and this sounds like the worst outcome, is if claims are LOW, say below the 220,000 mark.
Yes, that's the tricky one, because that would suggest a strong labor market on paper. But without any corresponding inflation data to justify keeping rates high, well, it removes the Fed's justification to cut without providing the inflation data needed to justify patience. It just amplifies the underlying uncertainty. It's a potentially terrifying scenario where a good unemployment number actually makes the market more nervous.
More nervous because the picture is incomplete. Wow.
And crucially, there are no Fed speakers scheduled today to come out and manage the market's reaction to that 8:30 a.m. number. So expect volatility, especially if we hit that second low claims scenario.
Definitely something to watch. Okay, let's wrap up with the technical roadmap for the S&P 500. It closed yesterday at 6,850.92. What are the key levels we are watching today?
Right? Immediate resistance. The ceiling is right there at that 6,850 level. Technical analysis identifies this as a major option gamma level, which simply means heavy options trading interest around that price has created a kind of technical ceiling. It successfully capped the market's advance yesterday. Bulls really need to break through that. The next target above would be 6,900.
Okay, 6,850 is the ceiling. And what about the floor? Where's the line in the sand for this bullish move?
The critical support level to watch is the 50-day moving average. That's currently around 6,668. And this is hugely important historically because the S&P 500 has not actually closed below that key short-term trend line since way back in April. A break and close below 6,668 would signal that this sector rotation might be turning into something more serious, a deeper structural correction.
Got it. 6668 is the key support. So to summarize the morning, everyone, you are dealing with the 3 Rs. The relief from the shutdown ending is undeniable. The rotation is dominant. Definitely watch that Cisco versus NVIDIA dynamic. And the reality check on economic health is due sharp at 8:30 a.m. with that single, lonely, jobless claims figure.
And given the White House actually warned that those critical missing reports, like October's CPI and the jobs report, might never be released due to the interrupted data collection. Here is the final thought for you to consider today. How do the Fed and investors actually price long-term risk and make crucial decisions based on permanently incomplete data? How does the market even operate when the economic map is essentially half blank?
That's a fundamental question about valuation and policy in this new environment. Thanks for exploring this deep dive with us. We'll keep tracking the rotation and that crucial 8:30 a.m. number. And that's the bell. Thanks for listening to Bulls, Bears, and the Bell. Follow us to stay one step ahead of the market.